Hey everyone, and welcome back to the channel. Today we re-diving into a topic that's crucial for anyone who's worked hard to build their nest egg: wealth preservation. It's one thing to make money, but it's a whole different ballgame to keep it, protect it, and make sure it lasts for generations. You've put in the years, the sweat, and the smart decisions to get where you are. Now, let's talk about how to safeguard that success. So, what exactly is wealth preservation? Simply put, it's a financial strategy focused on protecting your assets from being depleted. Think of it as playing defense with your money. While wealth creation is about offense scoring points and growing your capital, preservation is about building a strong defensive line to protect your lead. The main enemies we're fighting against here are things like inflation, market volatility, taxes, and unforeseen life events. The goal isn't necessarily to hit home runs anymore, to avoid striking out. It's about shifting your mindset from aggressive growth to smart, sustainable stability. The first and most important pillar of wealth preservation is diversification. I know, you've heard this a million times. But its importance cannot be overstated, especially when you're protecting what you've built. Don't put all your eggs in one basket. If your entire net worth is tied up in one company's stock or a single piece of real estate, you're exposing yourself to massive risk. A well-diversified portfolio spreads your investments across various asset classes. This includes stocks, bonds, real estate, commodities like gold, and even alternative investments. Let's break that down. Within stocks, you should diversify across different industries and geographical regions. Don't just own tech stocks. Consider healthcare, consumer staples, and industrial sectors too. And don't just invest in your home country. Look at international markets. Bonds are your stability anchor. They typically have a lower correlation with stocks, meaning when the stock market goes down, high-quality, government, or corporate bonds can hold their value, or even go up, cushioning the blow. Real estate can provide a steady stream of rental income and long-term appreciation. The key is to create a blend of assets that do and all move in the same direction at the same time. This balance is what helps you weather economic storms without seeing your entire fortune wiped out. Now, let's talk about the silent wealth killer: inflation. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. If your money is just sitting in a low-interest savings account, it's actually losing value every single day. A 3% inflation rate means that $100 today will only buy you $97 worth of goods next year. Over a decade, that erosion is substantial. To combat this, your investments need to generate returns that are at least higher than the rate of inflation. This is where assets like Treasury inflation-protected securities, or TIPS, can be useful. Real estate also tends to perform well in an inflationary environment, as property values and rental income often rise with inflation. Even certain stocks and sectors that can easily pass on costs to consumers can be a good hedge. The point is, you can't just hide your money under the mattress. It needs to be working for you, just to stay even. Next up is managing risk. As your wealth grows, your risk tolerance should naturally decrease. When you were younger, you could afford to take bigger risks for bigger potential rewards because you had time to recover from any losses. Now, the priority is to protect your principal. This means avoiding overly speculative investments. That hot new crypto coin or that penny stock your cousin told you about? They might have a place for a tiny fraction of your portfolio that you're willing to lose, but they shouldn't be the cornerstone of your strategy. Instead, focus on high-quality, blue-chip companies with a long history of stable earnings and dividends. Think about companies that provide essential goods and services, the ones that people need regardless of the economic climate. Quality and stability become far more important than explosive growth potential. Another huge part of risk management is having adequate insurance. This is non-negotiable. Insurance is your financial safety net for the what-ifs in life. What if you get into a serious accident? What if a natural disaster damages your home? What if you face a lawsuit? Proper insurance, coverage, health, life, disability, property, and umbrella liability insurances, what stands between a personal catastrophe and a financial one. An umbrella policy is particularly important for high net worth individuals, as it provides extra liability coverage above the limits of your standard policies. Think of it as a cheap way to protect yourself from a lawsuit that could otherwise decimate your assets. Don't skimp on insurance. It's the armor that protects your financial fortress. Let's move on to one of everyone's favorite topics, taxes, or rather, minimizing them. Tax efficiency is a critical component of wealth preservation. It's not about how much you make, it's about how much you keep. High earners can see a significant portion of their investment gains and income go to the government if they do and plan carefully. There are many strategies for this. Utilizing tax-advantaged retirement accounts like a 401k and an IRA to their maximum is the first step. For those who have maxed those out, you can look into other vehicles. For instance, holding investments for more than a year allows you to qualify for lower long-term capital gains tax rates. Tax loss harvesting is another strategy, where you sell losing investments to offset the gains from your winners, thereby reducing your overall tax bill. You can also consider municipal bonds, whose interest is often exempt from federal and sometimes state and local taxes. Working with a qualified financial advisor and a tax professional is essential here. They can help you structure your portfolio and your finances in the most tax-efficient way possible, ensuring more of your hard-earned money stays in your pocket. Now for a topic that many people find uncomfortable but is absolutely vital: estate planning. What happens to your wealth after you're gone? Without a proper plan, the government could end up being one of your biggest beneficiaries through estate taxes, and your assets could be tied up in probate court for years. A well-structured estate plan ensures that your assets are distributed according to your wishes, smoothly and efficiently. This involves creating a will, setting up trusts, and designating beneficiaries for your accounts. Trusts can be incredibly powerful tools. A revocable living trust, for example, allows your assets to avoid probate and can provide for you if you become incapacitated. Revocable trusts can be used to move assets out of your taxable estate, potentially saving your heirs a fortune in estate taxes. Estate planning isn't just for the ultra-wealthy. It's for anyone who wants to control where their assets go and protect their loved ones from unnecessary stress and financial burden. It's your final act of financial stewardship. Finally, let's discuss liquidity. While you want your money working for you, you also need to have enough cash or cash equivalents on hand to cover emergencies and short-term needs without having to sell your long-term investments at the wrong time. Imagine the stock market crashes right when you need to pay for a major home repair or a medical emergency. If all your money is tied up in stocks, you'd be forced to sell at a loss. That's a terrible position to be in. Financial experts typically recommend having an emergency fund that covers 3 to 6 months of living expenses. For those who are retired or have less stable income, having even more, perhaps a year's worth of expenses in a safe, liquid account can provide immense peace of mind. This cash cushion allows your long-term investments to stay invested and do their job, weathering market cycles without being disturbed by life's unexpected turns. To sum it all up, wealth preservation is a multifaceted discipline. It requires a strategic shift from aggressive growth to prudent protection. It's about building a diversified portfolio that can withstand market shocks. It's about outsmarting inflation, so your purchasing power doesn't erode. It's about managing risk through high-quality investments and comprehensive insurance. It's about being tax smart to maximize what you keep. It's about thoughtful estate planning to create a lasting legacy. It's about maintaining enough liquidity to handle whatever life throws at you. This might sound like a lot, and it is. But you didn't build your wealth overnight, and you won't build a fortress to protect it overnight either. Take it one step at a time. Review your portfolio, check your insurance coverage, and start the conversation about estate planning. The most important thing is to be proactive. Don't wait for a crisis to start thinking about defense. By implementing these strategies, you can secure your financial future and enjoy the peace of mind that comes with knowing your hard-earned wealth is well protected for you and for the generations to come. Thanks so much for tuning in today. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe for more content on building and protecting your wealth. See you in the next video.